Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague Lawrence Gillum for this week's episode. Of course, Lawrence, we are going to talk about whether Fed Chair Powell's tenure is winding down or how soon it might wind down, because regardless, it's winding down because he's his term expires in May. But I also want to talk about my entrant into the Dad of the Year competition. I know you're an entrant too, especially for girl dads. I spent 11 hours yesterday at the Vampire Diaries Fan Fest. So is that enough to beat you out? Am I in the running?
I, yes, 11 hours for anything is a long time. Um, I'm not even sure what the Vampire Diaries are, but it sounds exciting.
It was a popular TV show. I never watched it. I never got into the vampire theme, which of course was really big maybe 20 years ago, 15 years ago. But maybe it sounds worse than it is, because I did enjoy parts of it, I will admit. And I know you've been to some concerts with your dad, as a dad with your daughters. That maybe was not what you wanted to be doing at that particular time, depending on the concert. So you're up there. I know you're a great dad, but
But
I
I will
thought
say though that the time spent with daughters, especially teenage daughters, worth every second.
any time is good time
That's
because you
right.
don't get much of it.
That's right.
They want to be with mom, no doubt. So thanks everybody for being with us here this week. We're gonna talk about the Fed debate with Powell first of all, but I also want to spend some time on earnings. The weekly market commentary is a bond market outlook with some commodity and currency thoughts as well. So certainly you can find that on LPL.com. We're not going to spend a lot of time on that. I'm going to really focus in on these two topics of Powell and earnings. And actually, that's really the week ahead preview too, because there's really not a whole lot of meaningful economic data this week. It's just earnings, 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 with a little bit of ECB mixed in. The European Central Bank does meet this week. So interested in your thoughts on that, Lawrence. So let's get to it. First, market recap. We had another week of more all-time highs for the S&P 500 on the equity side here. You see up 0.6%. I think the first thing to point out is that tech-led. We had the Trump administration relaxing export controls on NVIDIA chips. And so you saw certainly that stock had a good week. Therefore, of course, tech had a good week, and the Nasdaq had a good week. So that was where leadership was. But more generally, over the last several months, we've seen cyclicals and the riskier sectors outperform the defensive sectors. That continued last week, and that is certainly a barometer, we think, of the health of the economy. And so we're getting very positive signals there. Of course, when tech leads, you have growth over value. Looking globally, I think probably have to point out Hong Kong first. Here again, related to the softer tone out of the White House on U.S.-China relations. And then Brazil, not a softer tone, a massive tariff threat on Brazil, 50%, seemingly for political reasons, but nonetheless, that threat certainly hasn't helped the Brazilian market. So you've seen some volatility there. We also, Lawrence, got a pretty good week of economic data, so I'll let you weigh in on that in terms of how the bond market did last week. We got inflation data, we got retail sales, got some regional Fed data. How did the bond market react to last week's data?
Yep, there was some volatility, but at the end of the week, yields didn't really do much, despite the fact that we got some generally better than feared inflation data. CPI came in a little, hot relative to last month, but below expectations. So that was really a non-event. PPI data came in softer than expected. I think really what happened within the fixed income market, what markets wasn't necessarily the economic data, and we're going to talk about this, but it was the trial balloon of Trump saying he's going to fire Powell. Markets went crazy on that kind of announcement or that teaser, which we'll break down a little bit more in just a second. But all in all, it kind of ended up being just a flat week for the fixed income markets. Zeros across the board for the ag, the Treasury index, mortgage-backed securities. I guess, a big mover last week, big loser last week. The muni market. The muni market continues to struggle with the amount of supply coming to market. This is just through June 30th. Certainly, the numbers have increased since then, but since June or year to date through June 30th, there's been about $285 billion of new supply that's come to the market, with only about $10 billion of new demand. So when you have that type of supply demand mismatch, especially in a market that is dominated by primarily one investor base, which is the retail investor, you tend to get some dislocations between prices and I would argue fundamentals. So it's been a struggle this year. Year to date, the muni bond index is down 1.4%. The muni high yield index down 2.6%. The flip side of that is, and I've been saying this for the last couple of weeks anyway, is that the muni market continues to look really attractive relative to a lot of the taxable alternatives. It's been a tough slog first half of the year. I think things can turn around as those supply challenges hopefully remedy over the next 5.5 months. But it's been a challenging market in that market. But by and large, a kind of a quiet week last week in the fixed income markets.
Yeah, and they've maintained their tax favored status in the One Big Beautiful Bill Act. Not that anybody was too worried about that, but it was a rumor, a threat at one point. So thank you for the color on munis. I was wondering the same thing myself. Usually when munis are volatile, it's supply demand related, if it's not rate related. So that was certainly going to be my guess. Turning to commodities, we have a pretty good week in metals. You had solid gains for gold, silver, copper. Metals are getting support from tariffs. That's probably the majority of what's going on here, but we've also got a little bit more optimism around Chinese growth, that maybe there's a bottom in. You saw the strong week for Hong Kong last week. Certainly that's related to the tariff situation in the US, where you have, again, maybe a little bit better relations between US and China than people had thought a month or two ago. And so you end up with a pretty good session for metals. It wasn't really the dollar. The dollar's been kind of stable lately, maybe finding a base, a little bit of a bounce just over the past few weeks after being really oversold with extreme negative sentiment. Maybe that little bounce keeps going because there's just not too many incremental sellers to bring back in to push the dollar lower in the short term. So keep watching the dollar, of course, has been a little bit resilient here, even in the face of all these bears that are out there. So here's your S&P 500 chart. I think the most important point to make here, other than just to note that we had another all-time high last week, we're at, I think, 9 all-time highs, actually maybe 10 if we get one today. It's Monday, the 21st, July 21st, 2025, as we're recording this in the afternoon, and market has not yet closed. But anyway, so more highs. That's obviously great news. We're overbought, but not dramatically so. I also want to point out that there's a lot of support now. 61.44 was the last high that we broke through, so there's support there. But then you have some, you have the 20-day and the 50-day not too far away. Let's see, roughly 6,200 and 60, roughly 60.30. So hopefully those hold and we keep going higher. But we're at the point where it's fair to say that maybe there's, at least in the short term, maybe there's a little bit more downside than upside potential. Partly because this is the worst 3-month period seasonally on average for the stock market. So, hard to know whether we're going to pull back now or it's going to take another month or 2 or 3. But we do think we're getting to the point where maybe this rally needs to take a breather. So let's turn to the bond now. Bond market here, Lawrence, and I think this is really an interesting time to look at the bond market. I always list some questions for you when you are on the podcast. And this time I think I have maybe more questions than normal. So brace yourself. They won't be too hard, but brace yourself because some questions are coming. So here you go. Time running out on Powell's tenure? Question mark. What do you think?
Yeah, to your point, ultimately, yes. I guess it depends on when that tenure ultimately ends. You know, if you unless you've been living under a rock for the last couple of weeks, you've probably heard that President Trump is not a big fan of Jerome Powell. If you have been living under a rock, climb back under that rock because I'm tired of hearing about it too, because I'd like to live there as well. But because it's become a story that's a distraction to a lot of other things out there that are more important than this, in my opinion, anyway. The problem is that President Trump wants lower rates. The Federal Reserve has stated that they can't lower rates right now because there's still too much uncertainty as it relates to tariffs and the job market. There aren't clear signs that inflationary pressures have been ultimately quelled. There's a concern that if the Fed were to cut rates aggressively, uh, it would not get the desired effects with this security in particular. This is the 10-year Treasury yield. It's been trading in a range, and we think it's going to continue to trade in a range 4 to 4.5% throughout the rest of this year. The risk to that is if the Fed becomes overly dependent or politicized and the Fed starts to cut rates aggressively. I think in that scenario, you're going to see rates move higher and not lower towards with the back end of the curve. And that's going to put more pressure on mortgage rates. We're at what, 6.5, 7% on a 30-year fixed national mortgage rate. If the 10-year gets pushed higher because of the concern about inflationary pressures coming back to life, I think you could see a 5% tenure again, which would push those mortgage rates even higher. So it's not only kind of bad strategy, it's a bad look as well. And then just real quick though, I mean, presidents from all the way back to Truman have pressured the Fed. I mean, the main goal of any president is to get lower interest rates, especially when they're trying to service debt. But this one I think is going to be more problematic if he does try to push the boundaries and try to oust Chair Powell. He can only be fired for cause. And just today, I think that I saw that there was kind of a DOJ recommendation for perjury that was sent against Powell. So they're continuing to push this along, and that's just adding uncertainty to markets. And I think that that's going to continue to play out. And again, it's going to continue to push yields higher with that in focus. So the next slide I think is an interesting one because it actually breaks down the impact of what took place last week when Trump, floated that trial balloon out there about potentially firing Jerome Powell. This is from our friends over at Goldman Sachs, but this looks at the change in the various rates across the nominal market, the tips market, and the break-evens market. And what we saw last week with that kind of trial balloon is what you'd expect to see. You'd see the front end curves move lower, but the back end of curves, spike higher because of those concerns about inflationary pressures. So we saw the 2-year fall by about 4 basis points, the 30-year spike higher by about 7 to 8 basis points right after that announcement was made. Same thing on the tip side, Treasury inflation protected securities. Front end of curves moved lower, back end of curves moved higher. So you had this twist steepener, as it's called. But then probably most problematic is you saw break evens across the curve, fives, tens, 30s, all move higher. So one of the reasons why the Fed hasn't cut interest rates right now is because they want to keep those inflation expectations anchored. Despite the fact that we're not really seeing inflation right now, if those inflation expectations become unanchored, it's a self-fulfilling prophecy with inflation, and that starts to change behavior and it can get pretty problematic in terms of getting that inflation genie back in the bottle. So over that 1 hour period, I think that really showcased kind of how markets are thinking about a Federal Reserve that could potentially lose its independence. So it's not a good strategy and it's questionable legality. So hopefully it goes away soon, but it doesn't sound like it.
I mean, even if they come up with a way to fire him for cause, he'll he'll fight it, and then the legal battle will go on until May, potentially, right? And then his term's up anyway. So
Yeah.
I don't know. That would create some volatility still and some uncertainty, I would argue. But in the end, maybe it's a it's a little bit of a wash. I mean,
PIMCO put out a good uh, commentary, I think it was today, about what would happen if, in their view, if this does become overly political, in that Trump may not be able to get his desired candidate out of Congress or out of committee. So as so because the share of Democrats and Republicans is still pretty even within some of these committees, the Senate Finance Committee in particular, he would need all 13 Republicans to vote for his nominee to get out into a broader vote amongst the Senate, which means he would need people like Tom Tillis, who has, essentially said he's retired. Tom Tillis voted against the big beautiful bill and all these different things. So if he makes this overly political, again, it could backfire in terms of higher rates, but then he may not even get the candidate that he wants confirmed by the Senate. So again, I would like to crawl back under a rock and never hear this again, but unfortunately, I can't. And I don't think it's going to go away anytime soon.
yeah, let's continue to do great work for LPL Financial
That's
Research
right.
Team. Do not go disappear under a rock, please. So, thanks for that really, really interesting stuff. Again, that these challenges to Fed independence are not healthy for the bond market, clearly, or the equity market. But this will probably blow over.
Yeah.
So, what are you showing here,
Yep.
Lawrence? This next chart?
So I've shown this before, and
Block
I
number
think it's worth kind of re-showing though, because ultimately the goal of the Trump administration is to reduce the debt service cost of the amount of debt outstanding. This is the maturity wall of U.S. Treasury securities. Each one of those years represents when a portion of the debt outstanding matures. It's front loaded, as you can see here on this chart, because a lot of the debt that we have issued recently, not recently, but a lot of the debt that we have issued is in what are called T-bills. They have a maturity of 1 year or less. That's the orange bar right there. So $6 trillion of the $28 trillion of outstanding debt is in T-bills, and it's only the T-bill market that would be impacted by the Fed funds rate. So if the Fed does cut rates aggressively, like Trump wants to, it's only going to have a positive impact on $6 trillion worth of debt. The other 22 trillion, $23 trillion would likely be will have to get refinanced at higher rates, which again completely offsets the savings on the front end of the curve. So I don't know. I keep coming back to this. It doesn't make sense to continue to push this along, but it is what it is, and we can only bring the math, but the math doesn't really favor the disruptiveness that would come with a PAL exodus.
Yeah, that was going to be my question here. By issuing more T-bills, how can they really take the interest costs down materially over time? I mean, they're going to have that will benefit if Fed funds rate comes down.
Yeah.
That will help
The,
some, but it's really not. I mean, you basically answer the question. It's the bulk of the problem is beyond the T-bill time horizon, even though the
yeah,
Trump administration and the Treasury are ramping up T-bill issuance.
that's right. And the challenge though is that the more T-bill issuance that Treasury auctions off issues, that means the rollover risk is going to be higher for the Treasury debt stock, right? So if you're um, maturity schedule for the debt outstanding is front loaded. That means you're going to have to roll over that debt every year. So you're really beholden to short-term interest rates.
Mm.
And that really, again, puts more pressure on the Fed to keep interest rates low, despite what's going on in the economy, which means, inflation expectations, I think, would move higher in that event. So it's not a good long-term strategy. I mean, I get why they're trying to use bills and not fund with coupon paying securities, but I think that's just a short-term fix. The better solution, as we've talked about, would be to reduce the debt deficits and reduce debt issuance, but that's probably easier said than done. But I don't know that this is a long-term solution to our debt problem.
I would agree 100%. Uh, Thanks for that, Lawrence. Let's keep going. So, what is SOFR and why should we care about that as opposed to just the Fed funds rate?
Yep. So this is so. SOFR stands for Secured Overnight Financing Rate. This is kind of the expected cash rate over time. The reason why I use this versus the Fed funds rate is this is a lot more liquid. These are a lot more liquid securities than what you see out of the Fed funds futures. So particularly when you're looking at contracts that are kind of a year out, you tend to get some sort of liquidity premium embedded in there. So it's not really a great proxy for what markets are pricing in for the Fed funds rate. SOFR is because it is very liquid. And SOFR, what's priced in is a Fed funds rate of 3.5% as a trough rate. So over the next 50 years, markets are saying 3.5% is as low as it's going to go for the Fed funds rate, which is lower than, or I'm sorry, which is still higher than what the Fed has said is its neutral rate. And we wrote about this in the mid-year outlook piece because I think this is an important part of the puzzle. If you want to see interest rates fall from current levels, if you want to see the 10-year Treasury yield fall from current levels, you're going to need to see the Fed funds rate, or the Fed funds trough rate fall from current levels as well. What I like about what's priced in is that it's not pricing in any sort of kind of negative downturn over the next 50 years for the interest rate market. Um, we hope that's not. We hope that's the case. That there's nothing bad that happens within the economy or the global marketplace over the next 50 years. It's probably unrealistic. So this is a chart that suggests that there is potential price appreciation still in fixed income markets because of what's priced in. So if the economy does um, kind of slow more than what we were expecting, or if there's any sort of geopolitical event that could cause the Fed to cut rates more aggressively. I think that in that environment, you're going to see the Fed funds trough rate move lower, which is going to bring that 10-year Treasury yield lower as well. But until then, we're probably going to be around current levels, which was the purpose of that first chart that we showed, that 4 to 4.5%. But there is the potential still for price appreciation in the fixed income markets if things aren't as rosy as what's priced into fixed income markets over the next 50 years.
And if you're making a kind of a hedging call that the Fed funds rates might go down more than the market expects, are you better off just staying short intermediate part of the curve, or is that scenario enough to maybe extend duration?
So we're not there yet, but I think there will be a time to own duration. The economy is still pretty solid. There's some things that I'm sure Jeff Roach has talked about in terms of potential cracks, but by and large, things are still pretty good. So that 3.5% Fed funds rate trough is probably right for now. Um, but as our head of macro likes to say, hedge when you can, not when you have to. The risk return for owning a 10-year Treasury yield is pretty asymmetric right now. I just did the math this morning for the morning call for tomorrow morning, and the upside for a 10-year Treasury yield, if rates fall by 1%, is double digits. The downside for a 10-year Treasury yield, if yields increase by 1%, you're looking at like a 2% type loss. So if you are interested in hedging portfolios using a 10-year Treasury yield, for example, you're looking at pretty asymmetric return profiles right now. We're not doing that in portfolios yet. I think it's still too early. I think you're going to sit there with that 10-year Treasury yield with a lot of volatility, but trying to time geopolitical events is impossible. So if you are interested in using fixed income, long duration securities as a hedge, it might be worth a look. Well, I think we're still a little too early for that, but it's on the radar screen for sure.
Very good. Thank you for that, Lawrence. I got through all my questions. So let's move on to earnings season. I mean, you covered some of them before I even asked them. Moving on to earnings season, we've only had about 60 companies from the S&P 500 report. Actually, a little more than that if you count the companies that reported this morning. And we would say good start. Financial is really the bulk of the reports we've seen so far. And, that gets us from maybe this 4.8% growth rate you see here for second quarter S&P 500 profits to something more like 5.5. The average S&P 500 company is surprised by 8%, which is a very solid number. It's a little better than I think we saw last quarter. The dollar is giving a really nice boost because it was down about 7-8% year over year quarterly averages. So when the dollar's down, foreign profits earned by multinationals are worth more. So you give that a little bit of a boost. So I think that's helped. inflate the beat rates and the surprise factor for companies. But hey, we'll take it because tariffs are starting to flow through here. There has been margin pressure. I think in particular, you can see it in the consumer discretionary sector with retailers, but there has been margin pressure on companies that are most exposed to the tariffs that were put in place in April, started to come through, and in May to some extent. Obviously, we don't know where the final rates are going to go, and a lot of the reciprocal tariff threats haven't gone in yet, but we've still roughly quadrupled the rate. And it looks like 15% is going to be the lowest we'll see in terms of the average tariff rate. So there's a little bit more drag to come here, but companies have done a good job of offsetting it so far. And again, with help from the dollar, with help from a pretty good banking environment, because banks are what reported most. Banks and brokers have reported the most so far this quarter. They always report early. All in all, pretty good results. Here's your sector mix in terms of the quarterly year-over-year growth rates. This quarter's earnings is going to be led by big tech again. We're used to that. That's pretty much been the case for the past several years now. At the start of this year, though, a lot of people thought that would shift, and you'd end up seeing just as good of earnings growth from the 493 as you'd see from the Mag 7. Well, that gap really hasn't closed much. Still about tech leadership. We still think it makes sense from an asset allocation perspective to lean into large growth stocks, including tech, including communication services. And you see those generating the strongest earnings growth this quarter based on estimates and the companies that have reported so far. So we're talking about, north of 20% earnings growth of the Mag 7, and then, marginal, sort of mid-single digits, maybe growth for the 493. You throw all that together, actually, I would argue maybe not just mid-single digits, low single digits for the 493, and then you end up with maybe a growth rate of like 7. That's probably a good guess right now. Better than the 5.5 where we're tracking now, maybe 8 if all goes well. Obviously, a lot depends on how those big techs report, but that's a pretty good estimate at this point. Clearly, the economy is helping because Q2 was a pretty good economic growth quarter. Here is the estimate trends for the 2025 and 2026 years. So these estimates almost always come down. But what's interesting here is they've really leveled off. In other words, they have not come down over the last month. In fact, just over the past few weeks, they've gone up, which is really impressive. Not a lot, but even though you're only about maybe 15% of the way through earnings season, to have estimates go up at this stage for the broad S&P 500 is a win, and that is atypical. So there's some underlying earnings strength here. It looks like that the market has maybe recognized with the strength of the recent rally in stocks, but frankly, we didn't necessarily believe it. I think most of Wall Street, frankly, didn't necessarily believe that we could get, let's call it 263 in earnings this year and potentially 300 next year. But based on what I've seen, it's early, but based on what I've seen so far, you can't dismiss the potential that we actually get those earnings numbers. So we've said this in recent weeks that maybe our earnings numbers are too conservative. Tariffs have been managed maybe better than we thought. We'll see if they actually land, much above 15% or not. That'll obviously drive earnings. But to this point, I think you'd have to say that there's more underlying earnings strength than we thought, and these numbers, look at least possible. They're probably still stretch numbers, but at least possible. So market is obviously sniffing this out. We'll continue to follow comments from companies on tariffs and the estimate trends to see maybe if these numbers come down from here. They probably will come down a little bit, but we've been impressed so far. This week, of course, is an even bigger earnings week as we get further into the season and move away from just financials. We get 112 S&P 500 companies reporting this week, and Lawrence, I think that's going to get the most attention because I don't think the ECB is going to do anything all that interesting. I don't think they're going to do anything with rates. And the data calendar that you can see here doesn't really have anything all that exciting.
I would agree with that. Slow econ week this week. No Fed speak because of the Fed meeting next week. They're in their self-imposed blackout period, so no Fed speak, no Treasury auctions to really worry about either. So um, I don't want to say that I hope it's a quiet week, but I hope it's a quiet week.
Well, it'll be quiet if you're under a rock. But yeah, if you come out from that rock, hopefully you won't hear anything too much. Although we're used to it, there's policy curveballs coming from every which way here over the last few months. We'll probably get something that makes this week maybe a little noisier than we think. But at this point, yeah, quiet week. And obviously, the summer is just a quieter time anyway. So we'll follow the data, but you're going to end up, I think, still painting a picture of a pretty decent economy, slowing, but not falling off a cliff. Maybe a 1.5% kind of growth economy in the second half. Not two, but we're probably going to get north of two in the second quarter when GDP comes out at the end of the month, but then subsequently gets revised. So, yeah, so all in all, a pretty decent macro picture, and clearly the stock market likes it. So, I think with that, we'll go ahead and wrap. So, thanks, Lawrence, for the insight on the bond market and the whole Powell drama. We will, of course, keep following that. If anything does happen, it's probably going to be temporary, and we'll just sort of ride it out. But the bond market will react, and therefore the stock market will react as well if that call for Powell to be fired gets louder. Hopefully it won't. So thanks everybody for listening to LPL Market Signals. As always, greatly appreciate your interest in what LPL Research has to say. Thanks, Lawrence, for joining this week. We will see you next time. Everybody have a great week. Take care.